with the county accidentally. This video is called Interest Rate Cuts, Bond Discounts, and Bond Premiums. So as I record this in late August 2024, you see a headline here from Fortune. Interest rate cut expectations keep getting deeper as Powell, the Fed Chairman Powell, risk bias changes. We get an interest rate cut because the economy is slowing slightly. We cut interest rates to spur economic activity. If you're a bond investor, this has an impact on your portfolio. If you own individual bonds or you own bonds in a mutual fund and you sell the bonds, interest rate changes will affect the price you receive for your bond. So it's important to understand how interest rates change the value of your bond portfolio. Interest rates and bond prices. So let's assume Sally's an investor and she invests in a Vanguard investment grade bond mutual fund. She's in a bond mutual fund. And what's important to know is that the Vanguard portfolio manager can hold bonds until maturity or sell bonds, which is really the point of this discussion. An interest rate cut impacts the price received when the bond is sold, generating a gain or loss in the fund, and that gain or loss has an impact on the individual investor's tax return. So, understanding a bond premium. Let's assume that Vanguard owns a $10,000, 6% AAA rated IBM corporate bond. It's due in 10 years. When interest rates decline, the 6% 10-year bond becomes more valuable. And why is that? Well, new AA rated bonds from IBM or any issuer of the same quality will be issued at a lower interest rate. And that makes sense because the issuer wants to pay no more than the market rate for interest. So let's assume that new AA rated 10-year bonds have a 5.5% interest rate rather than a 6% interest rate. The price of the 10-year 6% bond will increase because the interest rate that it's paying is higher than the current market rates. When a bond is priced at more than the face amount, remember it was $10,000, it sells at a premium. It is a bond premium. So, for example, the Vanguard money manager sells the $10,000 bond for $10,500 and generates a $500 gain for the fund. Now, there's the flip side, which is a bond discount. Let's say same bond, $10,000, 6%, AA rated IBM corporate bond due in 10 years is less valuable when interest rates increase because new bonds, same rating, same years to maturity, have a higher interest rate than 6%. So when the bond is priced at less than the face amount, below $10,000, it's considered at a discount, a bond discount. The Vanguard money manager may sell the $10,000 bond for $980 and generate a $20,000 loss to the fund. So there are both gains and losses potentially in a bond fund. So the takeaway here is that in a bond mutual fund, the money manager may buy and sell bonds and not just hold them to maturity. And if they do, they generate gains and losses that are taxable to you, possibly on your individual tax return.